If you are an NRI watching this video right now, there's a very high chance you've been quietly losing money to the Indian tax system every single month for years and you don't even know it. Let me show you exactly how. Take an NRI in Dubai. 50 lakhs sitting in an NRO fixed deposits earning 7%. That's 3.5 lakhs in interest every year. Sounds great, right? Except his bank is automatically deducting 1.09 lakhs in tax. Every year, just gone, but there's a perfectly legal way to bring that 1 lakh tax down to say 44,000 or 65,000 every single year just from one FD. And in two specific cases, I'll prove to you later in this video, the tax can actually drop all the way down to zero legally. With recent rulings backing it up, it's called DTAA or the Double Taxation Avoidance Agreement. India has signed these treaties with the UAE, the US, UK, Singapore, Canada, Australia and Germany and many other countries. They've been active for years. They are sitting there right now waiting to be used. But here's the part that should genuinely make you angry. Your bank won't apply them. The income tax department won't remind you. Nobody in the system is incentivized to tell you this exists. Until you take action, your bank keeps deducting at 31% on your interest, 20% on your dividends, month after month, year after year. If you have had an NRO account for 5 years and never claimed DTAA benefit, you have likely overpaid tax every single month. So in this video, I'm going to walk you through DTAA country by country, the exact rates, the exact savings, and the two documents you need. What happens if you're moving back to India and how to avoid paying tax in two countries simultaneously. And the limitations nobody warns you about until you've already lost the money. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC and one of India's top wealth management firm before launching my own startup. This is Finicky, where I simplify money the same way I practice it. Okay, let's start with the basics, because if you don't get this part right, nothing else makes sense. When you live abroad and earn money in India, two countries technically have the right to tax that income. India, because that's where the money was earned, and your country of residence, because that's where you live. If there's no treaty between them, you pay tax twice. Once in India, once again in the country where you live. That's double taxation and it's brutal. DTAA stops that. It decides one simple thing: who taxes and how much. The relief itself comes in 3 forms. First, exemption. Your income is taxed in only one country and fully exempt in the other country. Second, tax credit. You pay tax in both countries, but your country of residence gives you credit for the tax that you have already paid in India. So effectively, no double tax payment. And third, a reduced withholding rate. Instead of India's standard TDS, a lower treaty rate is deducted at source. Now, before we move on, there are 2 things you absolutely have to remember. First, under the Indian tax law, you are allowed to choose between the domestic tax rate and the tax treaty rate, whichever one is more favorable to you. So, if the DTAA rate on dividend for your country is 25%, but the India's domestic tax rate is 20%, you simply go with the lower domestic tax rate. The key is to always compare, never assume. Second, and this is the single most important point in the entire video, DTAA is not applied automatically. If you don't submit the required documents, your bank will keep deducting tax at the standard rates every month, every year, until you do something about it. You have to actively claim these benefits, and I'll show you exactly how at the end of this video. But first, the country breakdown, because the savings are bigger than you actually think. Let's start with the country that has the most to gain, the UAE. And yes, this is the country that I just used in the opening example. So let's go deeper. The India-UAE DTAA is widely considered the most advantageous treaty for NRIs. And the logic is simple. The UAE levies 0 personal income tax as of date. So when you combine that with the India's tax treaties, several types of Indian income end up being taxed very lightly, and in some cases not all. Take NRO interest first. Without DTAA, 31.2%, with the DTAA capped at 12.5% for most interest. Let me put that in real numbers, picking up exactly where we left off in the intro. 50 lakhs in an NRO FD earning 7%, that's 3.5 lakhs in annual interest. Without DTAA, your TDS would be around 1.09 lakhs. With the treaty rate of 12.5%, it drops to 43,750. You save about 65,000 every year on just one FD, just by filing the right documents. Now look at the dividends from Indian companies. The standard NRI rate is 20%. Under the India-UAE DTAA, it comes down to 10%. Cut it into half. And now here's where it gets really interesting. Capital gains. Under Article 13 of the India-UAE DTAA, India retains the right to tax gains from shares of Indian companies. So, If you are a UAE resident and you sell Indian equity shares directly, those gains are still taxable in India. But, and this is the part most NRIs don't even realize exists, recent rulings and professional commentary suggest that units of Indian mutual funds and some other securities that are not legally classified as shares can fall under what's called as a residuary clause of Article 13. So what's the translation? If it's not legally a share, the UAE alone gets the right to tax it. And since UAE doesn't tax capital gains at all, this can effectively mean zero tax on those mutual funds gains, provided of course that you have proper UAE TRC and other documentations in place. This area is still evolving, so always check with the tax advisor before making large transactions. This is the first of the 2 zero tax cases I promised you in the intro. The second one is coming up shortly. But first, DTAA does not help with everything. Capital gains for selling property in India are always taxed in India, regardless of where you live. For NRI selling properties held for more than 24 months, long-term capital gains on transfers are generally taxed at 12.5% without indexation. To qualify for these UAE benefits, you need to be a UAE tax resident. This usually means meeting UAE's residency criteria, commonly at least 183 days in country or satisfying alternative tests with strong ties, and the obtaining of a tax residency certificate from the UAE Federal Tax Authority. See, there are timelines that you need to match, but always safer to at least a month before the financial year starts. Next up, the USA. And this one comes with a twist no other country or treaty has. Most countries follows a simple rule. You leave, you stop paying tax there. But America doesn't work like that. The India-US DTAA was signed in 1989 and last amended in 2000 and remains unchanged as of February 2026. It covers all major types of income, but here's the thing. The US taxes its citizens and green card holders on their global income, no matter where they live, no matter how long they've been gone, and buried inside the treaty is something called as the saving clause under Article 1. In simple terms, even with DTAA, you can never fully escape US tax on Indian income ever. The treaty doesn't free you, it just makes sure you are not taxed twice on the same rupee through the foreign tax credit mechanism. So let's look at how this actually plays out. For NRO interest, the standard TDS in India is 31.2%, but under the India-US DTAA, it's capped at 10 to 15%. So if you earn 10 lakhs in interest annually, you save around 1.62 lakhs each year. For dividends, the treaty rate is 25% under Article 10, while India's domestic rate is 20%. Since you always apply the lower of the two, the domestic rate applies here, which means the DTAA doesn't actually give you any extra benefit on dividends if you're an US-based NRI. This is exactly why I told you earlier, always compare, never assume. When it comes to capital gains, both the India and the US have the right to tax them, and here's where the rates actually differ between countries. For listed equity and equity-oriented mutual funds, India now taxes capital gains at 12.5% after the 1.25 lakhs exemptions annually, and short-term gains at 20%. In the US, long-term capital gains are taxed at 0, 15 or 20% depending on your income bracket, and short-term gains are taxed at your ordinary income rates. In practice, you pay the tax in India first and then claim a foreign tax credit in the US so that the same gain is not taxed twice. There are also strict compliance requirements. If you are a US citizen or a green card holder, you must file an annual tax return using Form 1040, disclosing foreign bank accounts through FBAR if balances exceed $10,000 in aggregate at any point, and report foreign financial assets under Form 8938. The penalties for non-compliance? Significant. To claim DTAA benefits, you will need IRS Form 6166, which can easily take several weeks to arrive. The IRS itself recommends applying at least 45 days before you need it, and in practice, many NRIs see a 4 to 6 week turnaround. So apply well in advance of the financial year. The next country I'm going to cover is the one where if you play it right, your capital gains tax on Indian mutual funds can legally drop to zero. That's the second zero tax case I promised you. But before I get there, if this video is saving you tax already, hit subscribe so the next one finds you too. Okay, the next country India has DTAA with is Singapore. And this is the second of the 2 zero tax cases I promised you at the start of this video. Let's start with the NRO interest. Without DTAA, it's 31.2%. With DTAA capped at 15%, a big drop. For dividends, the tax rate is 15%, while India's domestic tax rate is 20%. So the lower of the two applies, which means 15% DTAA rate actually kicks in. Clear benefit here as well under the DTAA. But the capital gains is where Singapore really stands out. Under Article 13, gains from shares of Indian companies are generally taxable in India. However, there's been a recent discussion around mutual funds. In a 2025 Mumbai ITAD ruling in the Anushka Sanjay Shah case, it was held that mutual fund units may not qualify as shares under the treaty and therefore could fall under the residual clause, making them taxable only in Singapore. And since Singapore does not tax capital gains, this could effectively mean zero tax. But there's a limitation here. The India-Singapore DTAA includes a limitation of benefits clause, which primarily applies to entities, which means to claim certain capital gains benefits, companies must demonstrate real economic substance in Singapore, such as having an office, employees, and sufficient business expenditure. For individuals, the key requirement is genuine tax residency rather than meeting a fixed spending threshold. But you should still confirm this with a tax advisor before making any significant investment decisions. So, to claim DTAA benefits, you will need a tax residency certificate from Singapore's tax authority, which is the IRAS. This is typically processed within 2 to 4 weeks, making this one of the faster jurisdictions out there. With Singapore covered, now let's look at the UK, Canada, and Australia. On interest, these three are basically identical. On dividends, there are some differences, so stay with me here. For NRO interest, all the three treaties cap the TDS rate at 15% compared to the standard 31.2% in India. So if you're a UK-based NRI earning 2 lakhs a year in NRO interest, your tax drops from about 62,000 to 30,000. That's a saving of 32,000 annually just by submitting the right documents. But on dividends, it's not the same. For UK and Australian residents, the DTAA caps dividend tax at 15%. It's still lower than the India's 20% domestic rate. So UK-based or Australian-based NRIs benefit from claiming the treaty rates on dividend. For Canada, this is where it gets tricky. The treaty rate is 15% only where the company holds at least 10% of the India's company's voting power. In all other cases, meaning most retail investors, the cap is 25%, which is higher than the India's domestic rate of 20%. So for most individual Canadian NRIs with small holdings, India's domestic 20% rate is actually more favorable than the 25% treaty rate. So the one line takeaway, UK and Australia gets the dividend benefit, Canadian retail investors don't. Always compare before you claim. Now for capital gains on India shares, all the three treaties allow both countries to tax the income. In practice, you pay tax in India and then claim a foreign tax credit in your country of residence to avoid being taxed twice. Now here's a trap lots of NRIs walk into straight. They assume that the moment you board a flight out of their host country, they stop being a tax resident there. Wrong. In Canada, the CRA has a strict deemed residency rules. If you maintain a strong ties like a home, spouse, or dependent children, you may still be treated as a tax resident even if you have been abroad for years. In Australia, the ATO applies similar detailed residency test, and many people with property or family ties have been classified as residents despite living overseas. And in the UK, HMRC uses the statutory residence test, which looks at factors like time spent in the country and personal or economic ties, meaning you could still be considered resident depending on your situation. If you happen to be regarded as a tax resident in two countries, then something called as a tiebreaker rules, usually prescribed within the DTAA, have to be applied to determine in which country you will be taxed as a resident. I'll talk about this in a bit more detail soon. To claim DTAA benefits, you will need a tax residency certificate, and timelines vary by country. Now, the one country that doesn't get nearly enough attention in the NRI finance discussion is Germany. Even though the India-Germany DTAA quietly offers some of the most competitive tax rates among major destinations. For NRO interest, the treaty caps the rate at just 10%. Without DTAA, it's 31.2%. With DTAA, it's 10%, less than 1/3 of the default rate. Let me show you what that actually looks like. Take the same 50 lakh NRO FD earning 7%, 3.5 lakhs in annual interest. Without DTAA, you would lose about 1.09 lakhs in TDS. But under the India-Germany treaty, just 35,000. You save almost 74,000 every year. Dividends are also taxed favorably, treaty rates of 10% versus India's domestic 20%. So the DTAA clearly applies and delivers meaningful savings. For capital gains, both India and Germany retain the right to tax, but you can claim a foreign tax credit in Germany for taxes paid in India like any other treaty that we spoke about. Let me give you a few more examples of how this works. If a resident of Germany sells property in India, the profit may be subject to India taxation. Put simply, if the asset has roots in India, the India taxes it first and Germany credits you for what you have already paid. Given Germany's relatively high tax rates, claiming the foreign tax credit step is crucial to avoid double taxation. And honestly, if you're a Germany-based NRI earning interest from NRO FDs or receiving dividends from Indian stocks and you haven't submitted your tax residency certificate, you're almost certainly overpaying by a significant margin. Okay, I hope that was not too heavy. So before we get to the documents, there's one situation I have to address because this is where a lot of NRIs gets destroyed financially without realizing it. Imagine this, you have spent years building your career in the US and you decided to move back to India in August. Sounds like a clean transition, right? Pack up, fly home, start over. Except now you've walked straight into one of the trickiest tax situations possible, dual tax residency. Here's why it happens. The US tax year runs from January to December. The India tax year runs from April to March. The US considers you as a tax resident if you have spent more than 183 days in the calendar year. India considers you a tax resident if you have spent more than 182 days there in a financial year. So if you leave US in the August, you've already crossed the 183-day mark there. And if you arrive in India in August, you will cross the 182 mark here too. Which means both countries now claim you as a tax resident. For the same financial year or same tax year, for the same income, without proper planning, your effective tax rate in this scenario can go very high. This is exactly where DTAA earns its keep. Article 4 of most Indian DTAAs lays out a tiebreaker rule, applies in a specific order to determine which country gets the primary residency for tax purposes. It looks at 4 things in sequence. First, which is your permanent home? If you have one in both countries, then second, where is your center of vital interest? Meaning your family, your business interest, your primary bank accounts, your strongest personal and economic ties. If that's still unclear, third, your habitual abode. Where do you actually spend most of your time? And finally, if none of those resolve it, your nationality decides. Think of it as a 4-step ladder. The treaty walks down each step until one gives a clear answer. Whichever step decides it, that's the country you primarily belong for a tax purposes. The practical implication, if you're moving back, document everything. Day count records, passport stamps, rental agreements, bank account locations, family residences, because the tiebreaker only works if you can prove which side of the line you're on. Once your residency is established, you can claim foreign tax credit in the appropriate country. Each of these has its own deadlines, and getting them wrong is what creates the double tax disaster in the first place. Now, before I move on, I also want to clarify this before anybody comments, is that US alone doesn't look at the 183 days in that particular year. It also looks at the number of days stays in the previous year. So please consult your tax consultant there as well for determining what's your tax residency in the US. So if you're planning a return, talk to a qualified cross-border advisor at least a year in advance, not a month, a year. The planning window matters more than the paperwork. Okay, this is the part you came for. Everything we have discussed so far, all the savings, all the reduced rates, the UAE 12.5%, the Germany 10%, the Singapore 0% on mutual funds, all of it comes down to 2 documents. That's it. 2 pieces of paper, that's the entire wall standing between you and a significantly lower TDS rate. And remember, your bank isn't going to chase you for these, you have to bring them to your bank. The first is the tax residency certificate or the TRC. It's issued by the tax authority of the country you live in, and it confirms that you are a recognized tax resident there for a specified period. That's what allows you to claim the DTAA benefit in India. No TRC, no treaty rate, it's that binary. And here's the catch most people miss. You have to apply for the TRC before the financial year begins, not after the income has already been received. If you're late, your TDS is already gone and you're stuck claiming a refund through a tax return, which can also take months. Also worth noting, the TRC needs to be renewed annually. It's not a one-time document and the timelines vary by country, typically ranging from 2 to 8 weeks depending on the country. The second document is the Form 10F. This is the self-declaration filed on the income tax portal. It includes details like your name, PAN, tax identification number in your country of residence, the relevant period, and the country whose treaty you are claiming. And even if you don't have a PAN, non-residents who are not required to hold one can still register and file Form 10F. Once both the documents are ready, they need to be submitted directly whoever is making the payment to you. If submitted in advance and accepted, TDS is deducted at the treaty rate itself, which means you avoid excess tax deduction and the hassle of claiming refunds later through an income tax return. Before I wrap up, you need to understand the limitations of DTAA because it's far better to know this now rather than discover it the harder way later. First, rental income from property in India is always taxed in India regardless of where you live or which treaty applies. The DTAA does not change this. What it allows is for you to claim a foreign tax credit in your country of residence, but the primary taxing right stays with India. Second, penalties and interest for delayed taxes are not covered under any treaty. If there are compliance gaps or delays, those consequences are entirely on you. Third, DTAA is not a tool to eliminate taxes altogether. It's designed to prevent double taxation, not to create zero taxation globally. If you are earning meaningful income from India, the expectation is that you will pay tax somewhere, either in India or in your country of residence. And finally, DTAA is optional, not automatic or mandatory. You should always compare the treaty rate with the domestic tax rates and choose whichever is lower. Many NRIs apply DTAA by default without checking, even in cases where the domestic rate is actually more favorable. There's one more tool worth knowing about, especially if your Indian income is on the smaller side. It's called the lower or nil TDS certificate. Most people think this only applies if your total Indian income falls below the basic exemption limit of 12 lakhs under the new tax regime. But the actual legal test is broader. If your real Indian tax liability for the year, whether because your income is within the exemption band or you have significant losses or significant deductions, is lower than what the standard TDS would otherwise deduct, you can apply to the Indian Income Tax Department for this certificate. Once granted, it instructs the payer to deduct tax at a lower rate or even zero rate. Especially helpful for NRIs whose Indian income is modest but still subject to high default TDS. So here's the bottom line. If you're earning any income in India, whether it's NRO interest, dividends or equity gains, and you haven't submitted your TRC or Form 10F, there's a very high chance you're overpaying tax. These treaty benefits are completely legal and readily available, yet most people never use them. In reality, it just takes 2 documents and few weeks of processing to significantly reduce your tax outflow. One practical note before you go. Tax laws evolve every year. The rates and the interpretations covered here are based on financial year 26-27. For your specific situations, especially if you're dealing with large transactions, property sale, US residency, or planning a return to India, it's always wise to check with a qualified cross-border tax advisor. If this helps, share this with an NRI friend who might be overpaying without even realizing it. Drop your country in the comments and let me know what DTAA question you still have, and if you're not already subscribed, make sure you are. Most NRIs don't lose money because they earn less, they lose money because they don't know this exists. And now you do. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Finicky. Thanks for watching and I'll see you in the next one.